Howdy, Jacob here. Today we're looking at the next company on our generic screener, ticker symbol CWST in the commercial services and supplies industry. 6.2 billion market cap on 6.9 billion enterprise value, founded in 1975. They're a vertically integrated solid waste service company. So they provide non-hazardous solid waste services, collections, transfer stations, recycling, etc. And the growth has been very impressive for being around since 1975, over double revenue of the last 10 years with increased gross margin, increased operating margin. And although it is low, it is increasing. So 8 to 9% is honestly not terrible. And 30 to 35% gross margin, not bad. They don't pay any dividends. Their return on invested capital averaging mid-single digits, so really nothing to brag about there. With a balance sheet that has 221 million cash on hand, 36 million short-term debt, and $1 billion long-term debt. Looks like they made a large acquisition here that they went into debt for and funded it likely through other avenues, but property and plant went up, 500 million of goodwill. Cash flow statement shows an 852 million net acquisition. And outside of that, they really pretty consistent of making acquisitions. Their capital expenditures are very high. They're 3 times higher. Luckily, their cash from operations is 4 times higher, so they are creating money through free cash flow. And again, they're just making acquisitions with almost everything that they have here. So for me, this $1 billion in debt with free cash flow averaging, again, maybe 75 million. That's a lot. That's a lot of debt. And again, we don't know if it's due in 2 years or 10 years. It'd be really quick to look up. But for me, that's just a lot of long-term debt, even in relation to their free cash flow and their cash on hand. So that's going to make me a little bit hesitant. Maybe in a true model, I'd put in an extra margin of safety here. So either way, let's get to it. Revenue growth. They've grown through acquisitions. I'm going to dampen their acquisitions because, again, they've used over 100% of free cash flow essentially the last couple of years for acquisitions. I'm going to say, okay, maybe 30 to 50% is to acquisitions, or 50 to 70% to acquisitions. And I think that's going to give me closer to maybe 7% revenue growth. And margins are all over the place, but let's put in 5 and 6%. Issuing of shares through stock-based compensation of 10 million isn't really doing much there, but they have increased shares as well as debt for some of these projects that they're funding. So maybe just 1% increase a year. Their terminal P and price free cash flow has grown essentially through acquisitions, and although their margins have increased, they're still pretty low. And I mean, maybe I'll give them the market average. I think I'm comfortable with that. So this is set with these assumptions. The company's stock price needs to fall 90% before we get the price we're looking for here. I mean, we have a 320 PE with, their earnings per share was dampened, but even if it triples, it's pretty much the highest it's ever been, and you're looking at 100 PE. I don't think they're able to grow as much in the future as they have in the past because they're going to have to start focusing on debt reduction. And if they don't, then I'm definitely not interested, not even close. So an interesting company. I think a lot of the metrics are looking good, but for me, that debt might be enough to hinder me away from it. And the stock price is just way off. So hope you enjoy the video and have a great day. Thanks.